Hey everyone, welcome back to Corporate Decoder CSW Industrials. Incorporated CSW just filed their proxy statement for the 2026 annual meeting, and I am looking at how they are balancing growth with shareholder returns. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is reporting record results. But with a big push into acquisitions, we need to see if that strategy is truly creating long-term value. CSW Industrials Incorporated, or CSW as it is known, is getting ready for its 2026 annual shareholder meeting. They are asking shareholders to vote on important matters like electing new directors and approving executive pay. This filing gives us a peek into how the company is performing and what its plans are for the future. It is like getting a report card for the past year, with a sneak peek at what is next. Let's dive into the numbers for the fiscal year that ended in March 2026. CSW saw some significant growth. Revenues jumped up by a solid 23.2%, hitting $1.1 billion. That is a big number and shows the company is selling a lot more products. Their adjusted earnings before interest, taxes, depreciation, and amortization, or EBITDA for short, also grew, going up 18.3% to reach $270 million. EBITDA is a way to measure how much money the core business is making before things like big loans or fancy accounting tricks. $1.1 billion plus 23.2% scroll adjusted EBITDA, scroll $270 million plus 18.3%. This means the company is not just selling more, but its operations are also becoming more profitable. However, operating cash flow, which is the actual cash generated from running the business, saw a slight dip of 11.1%. This can sometimes happen when a company is growing really fast, as they might be investing more cash back into the business, like buying more inventory or equipment. Scroll adjusted EPS scroll $10.38 plus 6.9% adjusted earnings per share, or EPS, which is how much profit is allocated to each share of stock, went up by 6.9%. While not as dramatic as the revenue or EBITDA growth, it is still a positive sign that earnings are growing, even if at a slower pace. Now, let's look at who is running the show. The company is asking shareholders to elect 7 directors for the upcoming year. One director, J. Kent Sweezy, is retiring, and they are thanking him for his 10 years of service. This is pretty standard for companies, having directors who oversee the company's strategy and make sure it is run properly. They highlight that their director nominees bring a diverse mix of backgrounds and experiences, which is great for making good decisions. They mention that 86% of their director nominees are independent, meaning they don't have a direct financial tie to the company other than their role as a director. This is important because independent directors are supposed to make decisions based on what is best for all shareholders, not just company insiders. They also point out that 43% of their nominees are female or diverse, showing a commitment to diversity at the board level. The company wants directors with a wide range of skills, from executive leadership and finance to industry knowledge and risk management. It sounds like they are trying to build a well-rounded board that can handle complex business challenges. Joseph B. Arms, the Chairman, Chief Executive Officer, and President, is up for re-election. He's been with the company since 2015 and clearly knows the business inside and out. His background includes finance and corporate development, which are key for driving growth. Darren K. Ash, CEO of Salmons Enterprises Incorporated, is another nominee. His expertise in finance and leading complex global organizations will bring a lot of value to the board. Michael R. Gambrill, a former executive vice president from Dow Chemical Company, brings extensive experience in the chemicals industry and global business operations. His knowledge in health, safety, and environmental issues will also be valuable. Bobby Griffin, the Chief Diversity Officer at Rockwell Automation Incorporated, adds expertise in human capital management and diversity and inclusion. This aligns with the company's focus on culture and employee well-being. Terry L. Johnston, formerly an Executive Vice President and Chief Operating Officer at Lennox International Incorporated, brings deep knowledge of the industrial markets and global operations. Dr. Linda A. Livingston, President of Baylor University and the Lead Independent Director, offers strong executive leadership experience and insights into business administration. Ann B. Motzenbocker, a former Managing Director at JP Morgan Chase Incorporated, brings strategic and financial expertise, especially in capital strategies and risk management. The board of directors recommends a vote for all these nominees. They believe this team has the right blend of experience and skills to guide the company. Now let's talk about how the company pays its top executives. This section is often a hot topic for shareholders. CSW states that their executive compensation program is designed to align executive interests with shareholder interests, reward current performance, drive future performance, and attract and retain key leaders. This is pretty standard language for most companies. Their executive pay is made up of base salary, annual cash incentives, and long-term equity incentives like stock options and restricted stock. They emphasize that a big part of executive pay is performance-based and at risk, meaning it depends on the company's and the executive's performance. For fiscal 2026, they claim that about 84.7% of the CEO's target pay was at risk. This is a good sign that pay is tied to results. They highlight what they do and don't do regarding compensation. They do promote pay for performance, benchmark against peers, and have stock ownership guidelines. What they don't do is pretty important too. No hedging or pledging of stock, no change in control excise tax gross-ups, and no out-of-pocket perquisites. This shows a commitment to shareholder interests. This is the say on pay vote where shareholders get to give their opinion on executive compensation. In 2025, they received 96.3% approval, which is a very strong endorsement. This year's vote is also advisory, meaning it is not binding, but the board does pay attention to the results. They are asking shareholders to approve the compensation of their named executive officers, or NEOs. The company really drilled down into their compensation strategy. They use a mix of base salary, annual incentives, and long-term equity. For their annual incentive program, or AIP, they use key metrics like consolidated EBITDA and operating cash flow. They also include individual performance as a factor. In fiscal 2026, CSW achieved about 95% of its annual EBITDA goal and 109% of its operating cash flow, or OCF goal. This resulted in a weighted average payout of 107.8% of target for these financial metrics. That means the executives earn more than their target bonus based on these company-wide results. For long-term incentives, they use performance shares and restricted stock. The performance shares vest based on the company's total shareholder return, or TSR, compared to the Russell 2000 index. In fiscal 2026, their performance shares vested at 190.7% of target, which is a very high payout reflecting strong performance relative to the market. This suggests the company's stock has performed very well compared to its peers in the index. Let's look at the numbers for the top executives. For fiscal 2026, Joseph B. Arms, the CEO, had a total compensation of $7,273,615. This includes his base salary, stock awards, and incentive plan compensation. James E. Perry, the CFO, earned $2,112,413. While these are substantial amounts, it is important to remember that a large portion of this is tied to company performance and stock value, as we saw with the at-risk pay discussion. $7,273,615 total compensation in 2026. $2,112,413 total compensation in 2026. It is worth noting that a significant chunk of this compensation comes from stock awards, which directly ties executive wealth to the company's stock performance. For example, Mr. Arms' stock awards alone were over $4.9 million for 2026. This table further breaks down the awards granted in fiscal 2026. It shows the potential payouts for annual incentives and the estimated value of long-term equity awards. For Mr. Arms, the target amount for his annual incentive was $1,202,500 with a maximum potential payout of over $2.4 million. This demonstrates a strong performance-based component to his compensation. As of the end of fiscal 2026, the executives held a significant amount of unvested equity. Mr. Arms alone had over $18 million in potential value from outstanding equity awards, with a large portion of that tied to performance shares. This shows a long-term alignment with shareholder value creation. And now for the number that always grabs attention, the CEO pay ratio for fiscal 2026. The ratio of CEO compensation to the median employee compensation was 194.6 to 1. This means the CEO earned about 195 times more than the median employee. The median employee in this case was an hourly manufacturing team member in the US who earned about $37,371 in fiscal 2026. This gap is substantial, although the company does note that they exclude employees from certain foreign countries in their calculation, which is a common practice but can sometimes make the ratio look better. This section shows a comparison between what the executives were paid and how the company performed over the last 5 years. It is interesting to see how compensation actually paid, or CAP, differs from the total compensation reported. In fiscal 2026, CAP for the CEO was significantly lower than his reported total compensation, primarily due to how stock awards are accounted for versus when they are actually realized. The company highlights EBITDA as a key performance metric and shows its trends over the years, which is a good indicator of its core business profitability. Let's look at the reconciliation of net income to adjusted EBITDA. This is where they pull out special items to show what they believe is the true operating performance. For 2026, adjusted EBITDA was $269.6 million, which is higher than their reported EBITDA of $250.5 million. They are adding back acquisition-related expenses, integration expenses, and other one-time costs. This is common, but it is important to remember that these non-GAAP adjustments can sometimes paint a rosier picture than the raw GAAP numbers. Similarly, they adjust net income and earnings per S-Hair to arrive at adjusted net income and adjusted EPS. For fiscal 2026, adjusted net income was $173.5 million and adjusted EPS was $10.38. These adjusted figures remove things like amortization of acquisition-related intangibles, which is a direct result of their aggressive acquisition strategy. Finally, shareholders are asked to ratify the appointment of Grant Thornton LLP as the independent auditor for fiscal year 2027. This is a routine matter, but it is important for shareholder oversight. The audit committee has approved this firm, and they will be present at the meeting to answer any shareholder questions. Looking at the fees paid to Grant Thornton for fiscal 2026, the company paid $2.4 million in audit fees and another $360,000 in audit. Related fees, these are significant but appear to be in line with the company's size and its need for robust auditing, especially with its acquisition activity. So, what is the verdict on CSW Incorporated? They are clearly in a growth phase fueled by aggressive acquisitions. Their revenues and EBITDA are up and their executive compensation is heavily tied to performance, which is a positive. However, the dip in operating cash flow and the significant gap between CEO and median employee pay are points to watch. The reliance on adjusted earnings also suggests that these acquisitions come with substantial integration costs and accounting complexities. What I am actually looking for is to see how their operating cash flow improves as they integrate these new businesses, and if they can sustain this growth trajectory without further significant one-time costs. That is my take. Stay decoded. If you found this analysis helpful, please like, subscribe, and join our Discord community for more insights, all linked in the description.